In the annals of Silicon Valley's most turbulent startup stories, the rise and fall of WeWork stands out as a vivid example of ambition gone astray. Founded in 2010, WeWork was one of the most valuable and hyped tech startups of the 2010s. With a peak valuation of $47 billion, it promised to disrupt traditional real estate through the shared office space model, appealing to freelancers, startups, and major companies looking for flexibility in a changing workforce landscape. Yet, only a few years later, it had become a cautionary tale of reckless expansion, unchecked ambition, and financial mismanagement. In this video, we're going to go over WeWork's journey from explosive growth to a spectacular implosion, examining its business model, corporate culture, and the lessons it left behind for the startup and venture capital worlds. 2010, Adam Neumann and Michael McKelvey co-founded WeWork in New York City. Neumann, an Israeli immigrant with a history of failed entrepreneurial ventures, had a big personality, infectious energy, and an uncanny ability to attract investment. McKelvey, an architect from Oregon, shared Neumann's vision of transforming office space into a community experience. The idea was simple yet powerful: offer a flexible, short-term alternative to long-term office leases, appealing especially to startups, freelancers, and small businesses. With its first location in New York's Soho neighborhood, WeWork provided open-plan, modern workspaces coupled with communal areas and on-site amenities like coffee bars and lounge spaces. The space was designed to foster collaboration and networking among members, creating an atmosphere unlike the traditional cubicle office. This focus on community and the experience of the workplace appealed to millennial workers and entrepreneurs who valued flexibility, creativity, and connection. Neumann and McKelvey positioned WeWork as more than just an office space. They branded it as a movement that would revolutionize the way people work. The vision was to offer not only workspaces, but also lifestyle. This framing helped differentiate WeWork from traditional real estate companies and attracted interest from investors who saw it as a part of the sharing economy, alongside companies like Uber and Airbnb. By 2014, WeWork had expanded beyond New York to other major US cities, tapping into a rising gig economy and the demands of a flexible workforce. As WeWork's popularity grew, so did its ambitions. Adam Neumann, an outspoken leader known for his boundless enthusiasm and high energy charisma, became the face of the company. He positioned WeWork as a company that was out to change the world, referring to the company's mission in almost religious terms. The grandiose vision quickly attracted attention from investors, including SoftBank, which poured billions into WeWork over the following years. 2016, SoftBank CEO Masayoshi Son was captivated by Neumann's vision and agreed to invest heavily in the company. Son's philosophy, investing in the future, meshed well with Neumann's ambitions, and the partnership became a defining factor in WeWork's rapid, almost reckless expansion. Neumann used SoftBank's funds to open new locations around the world, setting up WeWork spaces in cities as far-flung as London, Tokyo, and Sao Paulo. In many of these places, WeWork would launch multiple locations within a single city, often competing with itself in terms of proximity. At its height, WeWork's global footprint included over 500 locations in 111 cities across 29 countries. The company leased massive amounts of office space from landlords on long-term contracts, often paying a premium for high-end spaces in prestigious locations. It would then subdivide these spaces into smaller offices, renting them out on a monthly basis to customers. The approach allowed WeWork to grow rapidly without the upfront cost of property ownership. However, it also introduced a considerable financial risk, as WeWork was locked into long-term obligations while its revenue depended on short-term client contracts. Neumann's ambition, though, didn't stop at office space. Under his leadership, WeWork embarked on an ambitious diversification strategy, launching multiple ventures underneath the We brand. One of these initiatives was We Live, a communal living concept that aimed to bring flexibility and community of WeWork into the residential sector. We Live locations offered short-term apartment rentals with shared spaces for events, communal kitchens, and laundry rooms. However, We Live struggled to gain traction and faced challenges in regulatory compliance, high cost, and an oversaturated urban housing market. Another venture was We Grow, an educational initiative launched in partnership with Newman's wife, Rebecca, who served as its CEO. We Grow was envisioned as a progressive school for children, emphasizing creativity, individuality, and personal growth. However, the school's high tuition fees, a lack of clear educational mission, and the absence of traditional benchmarks for success led to mixed reactions from both parents and the educational community. WeWork also launched other offshoots, including a fitness and wellness company, an event and conference organizing platform, and even an ambitious plan to establish a WeWork airline. These non-core ventures were both costly and loosely connected to WeWork's primary business. They quickly drained resources and distracted leadership from the main business of office leasing. At its core, WeWork's business model had a fundamental flaw. The company's strategy relied on signing long-term leases with landlords, often extending 10 or 20 years, while offering tenants short-term leases that could be canceled with minimal notice. This lease-based approach exposed WeWork to considerable financial risk. And if demand declined or occupancy rates dropped, WeWork would still be liable for the substantial rent payments on properties that could quickly turn into financial burdens. Now, WeWork's valuation of $47 billion in 2019 was based on its branding as a tech company. However, critics argue that WeWork was, in essence, a real estate firm that should be valued accordingly. Real estate businesses typically command lower valuations than tech firms due to slower growth rates, higher capital expenditures, and less scalability. Nonetheless, WeWork continued to promote itself as a high-growth tech company, citing proprietary software tools and data analytics as justification for its high valuation. But ultimately, these technologies were not central to WeWork's operations, and its real value lied in its property leases and client relationship. WeWork's high valuation became increasingly difficult to justify as financial losses mounted. By 2019, the company was hemorrhaging cash, with some estimates placing its annual losses at nearly $2 billion. Despite its revenue growth, WeWork's high fixed costs and debt obligations created a precarious financial situation. Analysts and investors grew concerned that the company's growth had outpaced its ability to achieve profitability. And in August of 2019, WeWork filed its paperwork for an initial public offering, marking the first time that the public world would see the company's financials and governance practices in detail. The IPO prospectus quickly raised red flags. It revealed significant financial losses, Newman's control over voting shares, and questionable business practices that suggest a lack of oversight. One of the most controversial revelations was that Newman had personally trademarked the word "we" and then sold it to WeWork for $5.9 million. Although Neumann eventually returned the money amid public backlash, the move highlighted a troubling conflict of interest. The prospectus also revealed that Neumann had taken out large loans using his WeWork shares as collateral and had leased properties he owned back to WeWork, further raising concerns about self-dealing. Newman's unorthodox leadership style, which once fueled WeWork's growth, was now seen as a liability. Reports emerged of a chaotic corporate culture under his leadership, including allegations of lavish spending, such as using company funds for private jet trips, extravagant parties, and other perks. Additionally, Newman was known for his erratic behavior, which included bringing tequila to meetings and making grandiose, often unrealistic claims about WeWork's future. Investors were spooked, and the IPO valuation began to plummet. By September of 2019, it was clear that the public market would not support WeWork at its once lofty valuation. Facing pressure from investors, the board demanded Newman's resignation as CEO. And in a dramatic turn, SoftBank stepped out with a bailout package to save the company, and the IPO was indefinitely postponed. WeWork's valuation dropped from $47 billion to below $10 billion, representing one of the most dramatic collapses in the history of startup financing. After Newman's ousting, WeWork faced an uphill battle to stabilize its business. Under new leadership, the company embarked on a significant restructuring effort, focusing on its core business of out-of-office leasing while shedding costly ventures like WeLive and WeGrow. Thousands of employees were laid off as the company worked to reduce its expenses and streamline operations. SoftBank, which had invested billions, attempted to salvage its investment by appointing a new CEO. Sandeep Manthrai, a seasoned real estate executive tasked with refocusing WeWork on sustainable growth. Manthrai made significant strides in cutting costs, renegotiating leases, and reorienting the company towards profitability. The company even rebranded itself and eventually went public through a SPAC merger in October of 2021. However, its valuation at the time was a fraction of its peak. signaling the profound damage the IPO fiasco and Newman's mismanagement had done. WeWork's rise and fall offer valuable lessons for the startup world. First and foremost, the importance of financial discipline cannot be overstated. WeWork's business model, which relied on short-term revenue from flexible leases while committing to long-term real estate obligations, is a classic case of mismatch between liabilities and income. The company's failure to adjust its growth trajectory to match its financial reality demonstrated the dangers of rapid expansion without a sustainable business model. One other lesson they learned is the importance of strong corporate governance. Newman's unchecked power and the lack of accountability within the company's leadership led to conflicts of interest, financial management, and a toxic corporate culture. WeWork's downfall emphasizes the need for transparent, responsible leadership, particularly when companies are scaling rapidly. All of that to say that this is a reminder of the limitations of the growth at all cost mentality that demonstrates much of Silicon Valley. While rapid expansion can generate excitement and investment, it should never come at the expense of sound business practices, realistic financial projections, and a focus on long-term sustainability. All of that just to say, WeWork's insane rise and dramatic fall serve as one of the most striking cautionary tales in the modern startup ecosystem. The company's ambition to revolutionize office space combined with its charismatic leadership attracted millions in investment. But its unsustainable business model, unchecked corporate governance, and reckless expansion ultimately led to its downfall. The lessons learned from WeWork's story are invaluable to entrepreneurs, investors, and executives in understanding the delicate balance between ambition and caution, vision and practicality, and growth and responsibility. Although WeWork's future remains uncertain, its legacy serves as a stark reminder of the consequences of chasing growth without foundation. What are your thoughts on WeWork? Have any of you ever worked in a WeWork office or bought the stock? Let me know down in the comments below. And if you like videos like this, please leave a like and subscribe, and I will see you guys in the next one.